Think about the invisible plumbing that keeps a modern city running.
Right.
You turn on a faucet, water flows. You flip a switch, the lights come on. You never actually think about the millions of miles of pipes and wires buried underground because, well, the system just works.
Yeah, you just take it completely for granted.
Exactly. The foundation feels permanent. But what happens when a water main shatters miles away? And suddenly, the pressure in your own home just vanishes.
Oh, it's terrifying.
Right. The faucet gasps, the pipes shudder, and in an instant, your absolute trust in that invisible infrastructure is just gone.
Because you suddenly realize that the safety of your immediate environment is entirely dependent on forces you can't see and can't really control.
Right.
Once that underlying pressure drops, it doesn't matter how nice the faucet is, the whole system is compromised.
And that feeling of sudden, invisible structural failure is exactly what we're looking at today. Welcome to the Deep Dive. I'm your host, and as always, I'm joined by our lead analyst.
Great to be here.
So for you listening, let's set the scene. It is Saturday, March 14th, 2026. The financial markets have just experienced an absolutely brutal week.
Brutal is almost an understatement.
Yeah, the complex algorithms that quietly run the world's capital are practically sounding the alarm. Today, we're diving into a stack of highly technical weekend telemetry reports on the SP 500 and NASDAQ futures.
Along with a very stark status update from a quantitative trading algorithm known as the V4 Deep Credit Protocol.
Right, the V4. And it is a fascinating look under the hood.
It really is. We aren't just looking at the final price tags of stocks here. We're actually examining the raw data of how machine intelligence is processing a massive system shock in real time.
So our mission for this deep dive is to decode exactly why the market's seemingly permanent upward plateau was just entirely obliterated this week.
Yeah, we need to look at what the internal market plumbing is actually signaling.
And how these massive algorithmic models are navigating a sudden geopolitical crisis. Okay, let's unpack this.
Yeah.
Starting with the physical world catalyst.
Right, the macro governor. Because to understand the numbers flashing red on our screens, you first have to look at the physical reality driving them.
Exactly. The telemetry report makes it crystal clear that the dominant market narrative right now is entirely tethered to the Strait of Hormuz.
Yeah, that's the absolute center of gravity right now.
We're seeing an escalating conflict involving the U.S., Israel, and Iran. And look, just assessing its mechanical impact on the global supply chain impartially, the result is that this critical oil artery is functionally closed.
And to truly grasp the panic that's pricing into the markets, you really have to look at the raw mathematics of that choke point.
The actual barrel count.
Exactly. This closure is removing an estimated 11 million to 16 million barrels of oil per day from the global market.
That is it's staggering.
It's a massive, immediate void in the baseline energy supply that powers literally the entire global economy.
Now, I was reading the section on the International Energy Authority stepping in to help, right? The IEA.
Right.
The strategic reserve release. Yeah. The report notes they announced a 400 million barrel release to combat the shortage. And, on paper, 400 million sounds like a massive rescue package.
Sure, it sounds huge to a layman.
But if you just divide that 400 million by the 16 million barrels a day we're losing, that reserve release only plugs the gap for roughly 25 days.
Barely a month.
It feels like trying to plug a collapsed dam with a single piece of chewing gum. It technically helps, but the underlying problem is still going to wash you away.
If we connect this to the bigger picture, a physical supply chain shock of this magnitude completely overrides standard market fundamentals.
What do you mean by standard fundamentals, like earnings reports?
Yeah, earnings, historical trends, all of it. Because the stock market is essentially a forward-looking discounting mechanism. It doesn't price in today, it prices in a future reality.
Okay, track that.
And right now, the market is inherently risk-off until physical oil resumes flowing through that strait.
Which doesn't look like it's happening anytime soon.
No. The telemetry cites polymarket odds that heavily favor this conflict, extending well past 50 days.
Wow, past 50 days.
Yeah, and that completely rules out what analysts call the taco option.
The taco option. I love that term. That's the idea that geopolitical players can just declare a quick, face-saving victory, grab a taco, and move on.
Right, exactly, a quick de-escalation. But Polymarket is saying that's practically off the table.
Meaning the math of the 25-day reserve release simply doesn't stretch to cover a 50-plus day disruption. the market knows the buffer is going to run dry.
Exactly. The risk-off environment is essentially hard-coded into the trading algorithms right now because the timeline of the conflict exceeds the physical supply buffer.
Okay, so if the physical oil shock is the catalyst, how does that actually infect the broader economy?
Well, it hits the credit gate.
Right, let's talk about that.
Yeah.
Because looking at the telemetry's notes on inflation before this hit, it mentions that consumer price index data metrics like the trimmed mean and supercore inflation were finally settling into a really healthy 2 to 3% disinflationary band.
They were. Things were looking great just a few weeks ago.
So wait, I'm stuck on this. If the inflation battle was basically won last month, why is the market suddenly throwing those healthy numbers in the trash over a localized shipping disruption?
This raises an important question. How fast can market sentiment pivot when the underlying credit markets break down?
And the answer is,
Almost instantaneously. You have to remember that energy is the base input cost for literally everything.
because you need oil to move things.
Right. When crude oil shoots past $100 a barrel, that cost immediately bleeds into manufacturing, global transportation, food production, keeping the server farms running, literally everything.
Oh, wow. So those healthy 2 to 3% CPI numbers from last month.
The market immediately views them as ancient history.
And the data totally reflects that panic. The report notes that inflation swaps are now actively pricing in a severe upward shock due to that 100-plus crude oil.
Yeah, inflation swaps are spiking.
Just to be clear for anyone listening, an inflation swap is essentially an institutional insurance policy, right?
Yeah, it's a good way to look at it.
Was where massive financial players trade the risk of future inflation.
That's a solid way to frame it. When the pricing on those swaps shoots up, it means the smartest, deepest pockets in the world are bracing for a massive resurgence in inflation.
And we see the bond market aggressively confirming this, right?
How aggressively?
I want to dig into that bond market confirmation because the algorithm explicitly flags something called the TLT as a red light condition for equities.
Yes, the TLT is critical here.
The report says the Treasury yield proxy, the TLT, has slid down to 86.54. Why does a dropping TLT flash a red light for the stock market?
So the TLT is an exchange-traded fund that tracks long-term U.S. Treasury bonds.
Okay.
When the price of that fund drops to 86.54, it means the underlying bonds are losing value. And in the bond world, when prices fall, yields the interest rates those bonds pay, they skyrocket.
So rising yields mean the cost of borrowing money is spiking.
Exactly, spiking precisely when the global economy can least afford it.
The telemetry describes this as global dollar liquidity actively draining away.
It's evaporating.
And it highlights that toxic junk bond spreads have blown out past their critical safety thresholds. What does that actually mean?
Well, the spread is simply the extra interest rate, or yield, that investors demand to take on the risk of holding low-quality corporate debt compared to safe government bonds.
Like lending to a really risky company.
Right. When those spreads blow out, it means investors are terrified of bankruptcies. They are demanding massive premiums just to lend money to riskier companies.
And that's what the report calls the credit gate breaking.
Exactly. The credit gate is broken.
The telemetry actually uses the term regime shift to describe this breakdown.
That's the technical term, yeah.
Meaning the underlying rules of the game just flipped. We went from a bull regime, a market where you confidently buy every dip because credit is flowing, to a bear regime, where you sell every bounce because the foundation is cracking.
Yeah, when that credit gate breaks and borrowing costs soar, equity valuations simply cannot sustain their previous sky-high multiples.
The math just doesn't work anymore.
The math no longer supports the optimism, period.
Okay, so if the credit gate is broken and borrowing costs are soaring, how is that terror actually showing up on the trading floor?
It's getting ugly. Let's look at the Friday close.
Right, the Friday verified market close showed the SP 500 futures, the ES, closing at 6,625.25, and the NASDAQ futures closed at 24,335.25.
But the really important number is the volatility metric.
The VIX, right. It closed at 27.19.
Yeah. That VIX reading of 27.19 is the skeleton key to understanding the violent price action you were seeing on your screen.
How so?
Well, the VIX is the market's fear gauge. It measures the expected volatility priced into options contracts. And at a level above 27, we are firmly entrenched in what's called a negative gamma environment.
Negative gamma. The report keeps mentioning options dealers needing to stay delta neutral in this negative gamma environment.
Right.
Does that mean they're constantly trying to balance the scale so they don't lose money no matter which way the market moves?
That's the perfect visualization. Options dealers, The market makers who provide the liquidity so you and I can buy and sell instantly, they are not placing bets on whether the market goes up or down.
They just want to facilitate the trade.
Exactly. They make their money on the transaction spread.
Mhm.
So to protect themselves, they constantly hedge their massive books of options contracts to remain neutral.
Okay, makes sense.
In normal, calm conditions, their hedging activity naturally stabilizes the market. They buy when things dip a little and sell when things rise.
But when the VIX spikes to 27, that math violently reverses.
It reverses completely. In negative gamma, the math forces those same dealers to sell into market weakness and buy into market strength
Got it.
just to keep their scales balanced.
Wait, meaning they are forced to amplify the price swings?
Yes.
If the market starts to drop because of a bad headline out of the Middle East, these massive dealers literally have to sell billions of dollars of stock into that drop, pushing the price down even further.
Exactly. They become an accelerant. It creates a highly unstable, violent environment where intraday flushes are heavily exaggerated by forced dealer selling.
Here's where it gets really interesting. Because of all this options activity, the market creates these invisible walls that dictate where the price can and cannot go.
Yeah, the telemetry report maps them out beautifully.
The gamma flip line is at 6,700. The market literally has to claw its way back up to that 6,700 level just to mathematically suppress the volatility and get the dealers back to stabilizing the tape.
Look at the barriers above and below that line.
Right. The call wall has moved down to 6,750, and the put wall, which the report calls the undisputed safety net for the market, has dropped all the way down to 6,500.
It's a massive drop.
I want to make sure I understand the mechanism here.
Mhm.
Are these walls acting like magnets because millions of options contracts are set to expire at those exact price levels,
Yes, that's exactly it.
forcing dealers to aggressively hedge right at those boundaries?
You've got the mechanism exactly right. Those walls represent massive concentrations of capital. As the market price gets closer to 6,500, the gravitational pull of those put options increases, forcing even more selling to hedge them.
It feels exactly like a tilted pinball machine.
Oh, that's a good way to put it.
The ball is rolling faster and faster toward the bottom, but the flippers, those safety nets, keep dropping lower and lower down the board.
Yep. And because the SP 500 is currently trapped at 6,625, well below that 6,700 stabilization line, we're seeing the human toll of this mechanical breakdown.
The retail traders.
Exactly. Retail traders who bought the dip got caught severely offside.
The aggressive break below 6,700 triggered cascading margin calls.
Right. So smaller speculators are being forced by their brokers to liquidate their positions at a loss just to cover their debts.
The telemetry actually scans for this human element too. They use a social slang module that measures retail sentiment velocity on platforms like FinTwit and Reddit.
I love that module. What's it saying?
It shows total psychological capitulation. All those terms we used to see trending, the rocket emojis, the talk of generational wealth, they have entirely vanished.
It's not surprising.
The new vocabulary replacing them is bloodbath, cooked, and just widespread panic over World War III scenarios.
And meanwhile, the report notes that commercial hedgers are in a purely defensive posture.
Which is telling. Yeah.
Very telling. Institutional players are providing some floor liquidity during those extreme intraday flushes, but they are absolutely not initiating a new markup phase while the Gulf remains a war zone.
They're just hiding out.
They're just trying to survive the negative gamma.
Now, amidst all this widespread panic and the brutal liquidation of what the report calls high beta trash equities.
Which means highly speculative companies that swing wildly and don't actually make any profit.
Right, thank you. Amidst all that dumping, there's one piece of the telemetry that immediately stands out.
The divergence in the crypto assets.
Yes, we're looking at a sea of red, but then we look at Bitcoin. Bitcoin is down over 20% year to date, but strangely, it has climbed roughly 5% since the initial strikes in Tehran.
What's fascinating here is, if you look at traditional safe havens, like physical gold, they actually dipped slightly during that exact same geopolitical window.
And the data shows Bitcoin is currently trading with a very high correlation to the enterprise software sector, rather than acting like traditional digital gold.
Yeah, that correlation is key.
Capital is actively fleeing those high beta speculative names and moving toward defensive megacaps, energy majors, and surprisingly, software and crypto.
Right. The report suggests this is capturing speculative flows, betting on eventual institutional adoption and the Clarity Act?
I'm assuming the Clarity Act is the regulatory green light traditional finance has been waiting for to actually hold these digital assets.
That is the implication, yes. But the broader anomaly here is how institutional flows are beginning to treat digital assets in the face of actual physical war.
So let me ask you this. If Bitcoin isn't acting like digital gold anymore, but rather trading in tandem with cloud computing and enterprise software stocks, does that mean the entire premise of what makes a safe haven is changing for institutions?
That is the massive paradigm shift that telemetry is hinting at. I mean, think about it. If the Strait of Hormuz is closed, you cannot easily ship a physical barrel of oil.
Right.
You cannot easily transport physical gold or consumer goods. The physical supply chain is choked.
The boats just literally can't move.
Exactly. But a decentralized digital ledger, a global software network, it doesn't rely on maritime choke points.
Oh, wow.
It doesn't need physical shipping lanes to function. The market is beginning to price certain digital infrastructure not just as a speculative tech play, but as a sector inherently immune to physical world geopolitical blockades.
So it's a safe haven, not because it's a shiny rock locked in a vault, but because it exists entirely outside the physical logistics chain.
Exactly.
That's a wild realization.
It really changes how we have to look at asset allocation.
Now let's bring this all together by looking at the machine's ultimate playbook. We have the status update from the V4 Deep Credit Protocol.
Right, the algorithm itself.
Amidst the negative gamma, the broken credit gate, the oil shock, how exactly is this highly advanced quantitative algorithm choosing to navigate this chaos?
By completely refusing to participate.
Wait, really?
Yep. The algorithm triggered a 100% cash position. It liquidated all market exposure and is sitting entirely flat, 0.00.
It refuses to play in what it calls no man's land.
It's just sitting on its hands.
The telemetry specifically notes that amateur traders always try to immediately short the market the exact moment it breaks down, and they often get violently chopped to pieces in the inevitable dead cat bounces.
Oh yeah, it's a meat grinder out there.
But the algorithm simply refuses to step into that trap.
That cold, emotionless logic is what separates algorithmic survival from human panic. The system doesn't try to predict the evening news. It reacts strictly to the internal market plumbing.
So it's not trying to guess what Iran or the U.S. does next.
Not at all. For months, it kept its portfolio armored, carefully scaling down risk. But when that credit gate broke and the junk bond spreads blew out, the mathematical floor gave way. Its primary mandate instantly shifted to pure capital preservation.
The report details how standard technical setups are completely broken right now. It notes that the Qualamagi swing strategy,
The breakout play.
which is a structural momentum breakout play, is officially void. Attempting to catch a breakout in this regime, with the VIX at 27.19 and the macro environment choked off, is just fighting the primary trend.
You do not want to fight that trend.
So if breakouts are void, what is the machine actually waiting for?
Its only active strategy right now is what it calls the trap and reversal. It's a very specific mean reversion play.
And it demands incredible patience, right?
Oh, extreme patience.
It is waiting for an exhaustion flush driven by macro oil panic. It wants to see an intraday capitulation spike that drives the S&P down into that 6,500 to 6,550 liquidity pocket.
The poo wall.
Right. It literally wants to see the price test that dropping wall on a terrible headline regarding the Middle East.
But the mechanism here is crucial. It doesn't just buy the dip blindly when it hits 6,500.
What does it do?
It waits for the reaction. If, and only if, the price violently rejects that 6,500 zone and surges back up to reclaim 6,600 on massive volume.
Leaving a long lower wick on the chart.
Exactly, leaving that long wick. If it sees that, it will go long. And even then, it places a strict stop loss precisely at the absolute bottom of that capitulation wick. It demands mathematical proof that buyers have stepped in before committing a single dollar.
And if you look at the 3-day market direction probabilities that telemetry spits out, it's easy to see why it's demanding that proof.
The probabilities are grim.
It assigns a 45% chance of a continued downward flush testing that 6,500 put wall. It assigns a 40% chance of high volatility chop as the market violently digests the headlines.
That's 85% pointing to pain or chop.
Exactly. And it gives only a measly 15% chance of an aggressive short-covering relief rally that manages to reclaim that 6,700 stabilization line.
The probabilities heavily favor continued defensive posturing and violent price swings. The trapdoor is open, the dealers are in negative gamma, and the machine is just waiting to see if the market falls through.
So what does this all mean?
It's pretty clear.
It means that sometimes doing absolutely nothing, going 100% to cash and stepping away from the screen, is actually the most aggressive and smartest position you could take to protect your capital.
Absolutely.
For you listening, being well-informed right now means deeply respecting this regime shift. The clear lesson from the quantitative algorithms and this weekend's telemetry is that when the macro environment physically breaks in the real world, the technical setups and past assumptions, like the comforting idea that inflation was dead and buried, go entirely out the window.
You have to respect the plumbing.
You really do.
And, it leaves us with something deeper to consider as we watch this geopolitical shock unfold over the coming weeks.
What's that?
Well, if an emotionless, highly advanced algorithm's default response to a structurally broken world is to simply step away into 100% cash, what happens to the market's fundamental structure when every machine decides to do the exact same thing at the exact same time?
Oh, wow.
Does the ultimate safe haven just become the complete absence of participation?
That's haunting. When the invisible plumbing of the entire system shatters, the smartest move isn't trying to find a faucet that still drips. The smartest move is just to step outside and wait for the pressure to return. Thank you for joining this deep dive. Stay curious and stay safe in the chop zone.